Hello and welcome to this episode of Connected. Today we're going to consider the emotional side of investing and how advisors can help their clients with it. With me to discuss this today are behavioural economist Mark Pittaccio and Dr. Louis Williams, Head of Psychology and Behavioural Insights at Dynamic Planner. So welcome to you both. So let's kick off by talking about the regulatory side. Mark, I wonder what your views are as to how supply-side regulation has affected people's propensity to invest.
Well, it hasn't worked, has it? I mean,
I didn't like to say.
A basic answer. I mean, since RDR, I mean, I think a lot of regulation has been good and it has been well-meaning. And I think it's certainly helped to professionalise the profession. I like to regard it as a profession rather than an industry now. Certainly when I was an advisor. But what it's done in terms of getting the average person in the street who probably could do with some financial advice actually approaching somebody in order to get it, it simply hasn't worked. And all the research shows that even if that advice is offered free of charge, the uptake of it is extremely low, and quite often the people that do take it up are ones that have already got advice, and actually they're the ones that least need it. So most supply side regulation hasn't really done anything to help people who really need the advice to go and get it. And that's before you sort of even look at the environment around which people invest, their understanding of a need to invest. I mean, in my opinion, this goes right back to school. I mean, the fact that, everybody is going to need a bank account, everybody's going to need a mortgage. It's not taught in schools, but, we do know a lot more about oxbow lakes and scree and Latin phrases, which are absolutely very little use, I would suggest.
Expanding brackets and that sort of
Exactly, yes.
Yes, absolutely. And I suppose, you see it in the relative weightings in kind of cash ISAs and stocks and shares ISAs as well, don't you? Basics like that. So, Louis, do you agree that it's created barriers to financial advice?
Yeah, so when we think about this more broadly, when we're thinking about clients who are seeking financial advice, as Mark mentioned, we do find that those who tend to be more competent, more confident, higher levels of self-efficacy, they're the ones who are seeking financial advice more than the average client who might need a greater support. So, Mark, I wonder with targeted support, if this is a direction that may help support those clients. We've done some research on this. We have found that when we ask clients if targeted support will help reduce the complexity, reduce the confusion when it comes to investing, if this will be the case. And actually, a lot of the younger clients, a lot of the clients who have lower levels of wealth, those who we may see to struggle advice, we're saying yes. Now, obviously, Mark, I don't know. This is something we need to monitor and see what actually happens. But that is, I guess, promising for the future.
Well, you said it's reducing the complexity, but I think once somebody is in front of an advisor, I think I was told last week there are now 28 warnings between the advisor and the business actually being completed. That's not exactly an encouragement for individuals to invest. So we have all sorts of psychological barriers, but the truth is that most people don't even arrive at that decision about where they should invest. We all work in the financial markets. We understand the phrases and the vernacular, but most people don't really understand what a market is. They don't really know where to go. But what they do hear is headlines that say billions have been wiped off markets today, or the markets have been spooked. Well, I don't want to be spooked. I mean, it sounds, and the issue is we never ever get these headlines that say, the stock market has done incredibly well today as a result of this economic intervention. All those people that have got pensions are going to be, more richer today than they would have been if they'd left all their money in cash. I think that those headlines simply don't exist. because journalism is there really to tell, to tell many people what few people know. And a lot of those stories are alarming and they are disturbing, which is why they end up more proportionately on the front pages of newspapers than they would otherwise. And so the environment is difficult. Then you've got that creates a distrust. And again, trust is still shown. All the evidence shows trust is the biggest element of whether somebody engages with an advisor or not. Broad scope trust in the profession is getting better, according to the Edelman Trust Barometer, but it's still not where it should be. And I've always thought that the financial services as a sector never really took advantage of the fact that it was such a saviour in the pandemic. In 2008, the financial sector, you could argue, was responsible for the crash and what happened then. Around the pandemic and in 2020, the financial sector actually saved people. I mean, with the fact we had a robust financial system and interventions were made by governments, actually saved a lot of people. But we've never really leveraged that, so the public understand the good that the sector does. And in fact, engaging with it is really going to be to their benefit.
So, Mark, do you think what we really need is some sort of toning down of the regulatory onslaught that you get that sort of accompanies advice or any kind of investments, investing in ISA or on platforms and things like that, but then also somehow to persuade the media to go a little easier and actually put the good side of investing and making money as well.
Yes, I mean, I think, look, there are many things that I'm not doing in my life that I probably should because I'm not aware that they're to my benefit. And the truth is that that's the situation with most people and financial advice. Nearly everybody would benefit from some form of financial advice, but that message isn't out there. That's nothing to do with the regulator. That's actually the environment in which we live. And we have those situations in all sorts of other areas of our lives, especially around health and exercise and food and things like that. Behavioral economics has nudged people into a lot of good behaviors in health and well-being, not necessarily so much in wealth. So I think certainly regulators and governments could do something to use behavioral science and nudge theory to at least encourage people to engage with advisors. And once somebody's in front of an advisor, then actually all the research shows it's not really the product or the investment that really influences whether people make a decision or not. It's actually the advisor. And once an individual is with an advisor, that narrow scope trust is built, even though broad scope trust across the whole profession isn't necessarily there. Once you've engaged somebody, an individual advisor, and you've developed a relationship with them, that narrow scope trust then becomes extremely beneficial for your financial well-being.
It's interesting. Mark and I ran a study, an eye tracking study, looking at something similar to this. So we were looking at differences in advisors and clients. And as Mark said, the advisor, the way that they explain the information, the way that they present information has a big impact on how the client responds, how they behave, impulsive decisions that they make. And so you tend to find clients, when they don't have that support from an advisor, when they don't work closely with an advisor, then they engage more in some of these emotional biases that can have a negative effect on their behavior. So they focus on, like Mark's saying, what's happening around the world today. And you see that, changes in the markets today, they're focusing on that and making decisions based on that. Whereas they need the advisor alongside them to show them and explain what's happened over the past 5-10 years and how that type of decision or disinvesting right now could lead to a poor outcome.
Yeah, Louis, I don't know whether it was from a previous discussion we had, but the idea that inexperienced clients tend to look at the shorter term, is that right? So experienced clients will look over, a year, look at the performance of investments over sort of 3 years or 5 years or whatever, and the clients will look at sort of 3 months or something like that. Is it? Yeah.
Yeah, exactly. So there are a few biases that have a role to play there. If we think about present bias, people, if they are, experiencing uncertain times, they're going to be focusing on today, what's happening today, making decisions for today, not investing for the future, not saving for the future. But again, as you look across experience, the more experienced people are, the more they're taking into consideration those time periods. And as I said, we actually found through behavioral data that eye tracking data, this was that actually the less experienced investors were fixating visually. They were looking at what's happening right now in the moment along a performance chart. And so, yeah, exactly as we explained there.
But none of us are immune from bad news. It
Yeah.
doesn't matter how experienced you are. And we use this analogy a lot. There was a very interesting study done, and we've actually repeated it ourselves, which just shows how a slight change in a question completely changed what they're actually focusing on. So we asked people, how happy are you driving your car? And there was a very positive correlation between how happy they reported they were driving their car and the value of the car. So the more valuable the car, the happier they were driving it. And the correlation was was above 0.7. It was a very strong correlation. We then changed the question to how happy were you driving your car yesterday? And the correlation completely disappeared because people weren't even thinking about the car. They were thinking about the journey. They were the kids screaming in the back going, "Are we there yet?" The traffic jam that they were stuck in. So when we're working with advisors, we say, look, when markets haven't, have been a bit disappointing and maybe a client's received a valuation that isn't as encouraging as they would like, basically you can disappear down a wormhole talking about trade wars and what's happened in to create the last 3 months of downturn, or even the last month of downturn, the last day of downturn in case of Liberation Day. You can concentrate on that. And that is like asking, how happy were you driving your car yesterday? Well, in fact, if you then say, right, okay, I know that this this statement isn't probably what we want. Markets haven't been particularly kind to us. But let's remind ourselves of the purpose behind our investing in the first place. Are we still on track? And actually, are you happy with the service that we've been delivering since we started investing together 4 or 5 years ago? That is, how happy are you driving your car? So it's just by changing the emphasis. But what a lot of advisors do is they want to get their knowledge over about, we understand what's going on in macro global economics. Well, actually, the client just wants to know, look, I've got this narrative in my life about how I want things to turn out. Right. What I really want to know is, has the news yesterday affected that narrative? And then it's the advisor's job really to say, well, actually, it hasn't, or maybe we need to put a little bit more, maybe this is an opportunity, have that kind of conversation rather than, like I say, getting into the detailed economics of why there might have been a downturn.
So can we expand on that to talk about best practice for advisors and how they should handle the emotional side of investing?
Yeah, so I was going to say in relation to Mark's point there, that actually we've looked at the optimism, the confidence, the resilience of clients, depending on how long or how recently they worked with an advisor. And so we found that people who've never worked with an advisor, as well as people who previously worked with an advisor, had lower levels of confidence, lower levels of optimism about the future, lower levels of knowledge than those who were still working with an advisor. And that's not, as Mark mentioned, just about education. That's also about the emotional value of advice, providing this reassurance, providing the guidance. But I think it's really important from an advisor's perspective, which Mark looks at quite a lot, is being able to understand the client's needs in terms of their emotional needs. Are they someone who actually has a low level of composure that actually, when we're experiencing uncertain times like we are now, this is the type of client that I need to pick up the phone to and speak to first and be more proactive in the way that I engage with them. If there's someone who has a fear of missing out on investments, on opportunities, are they going to be making impulsive decisions that they may regret now because of things that are happening? So I think it's that's an area, when we're thinking about the emotional side, that's also an area that advisors need to be able to use well-designed measures to understand the clients, but then actually use that data in a way that they can then engage with them and interact with them in a helpful way.
Now, I know you've both done some work on personality factors and how they combine in the sort of melting pot of advice. Mark, I understand you've looked more at the advisor side. I wonder if you can talk a bit more about that.
Yes, I mean, I think this was driven from the fact that advisors were still very much being represented as a sort of foot in the door, transactional, highly extroverted individual. And I found this in media and on television programs. And I thought, well, these are simply not the advisors that I work with. So we did quite an extensive study. I mean, I think there are over 1,000 advisors originally involved, and we measured what are known as the big five behavioural personality traits. Sorry, but the big five personality traits. There are about 200 different personality traits that we have, but they all feed into these big five overarching personality traits. So they're the headlines, really. So conscientiousness is like your diligence. Do you basically, if you're target orientated, are you diligent in the way that you approach things? Your emotional stability is really around how resilient you are. Your openness to experience is your ability is your cultural side. It's like your ability to embrace change. Extroversion is very much, we know extroverts, gregarious, individuals, if you like. And agreeableness is how empathetic you are. The empathy you have with people. And what we actually found was that the most successful advisors, if they're measured in terms of fee income, actually it was emotional stability that was the most important thing. That emotional stability and openness to experience. And the interesting thing is that openness to experience measures the capacity to embrace change. And if you think of all the regulatory changes that advisors have had to deal with over the last sort of 15 years, if you weren't able to embrace change and deal with it, you probably wouldn't still be advising. So it was that emotional stability and emotional stability and openness to experience that predicted fee income for advisors. But then the interesting is when I started looking at the details, really breaking it down, we actually found that the personality traits between successful male advisors and successful female advisors were different. And the interesting thing was that agreeableness was actually the predictor of success as measured by fee income amongst female advisors. The reason it's unusual is agreeableness actually is normally negatively correlated with career success, because basically you end up agreeing to do things that aren't going to necessarily advance your own cause. But when I looked at it, what I thought was really interesting, again, this is something that the profession, I think, has really got to start shouting about, is the fact that regulation has changed the nature of advice. So you can still be quite assertive in terms of what you want the client to do, which can be quite a male way of approaching things. Or you can be very empathetic. You can get into the shoes of your client and try to understand how they're experiencing things, which is very much more a female personality trait. Now, that collaborative idea and the collaborative nature of advice has meant that really this is a fantastic career, an opportunity for women to get involved in. And when then we did further research into paraplanners, what we found is that virtually all male paraplanners, the vast majority of male paraplanners wanted to go on to be advisors, but the vast majority of female paraplanners wanted to stay as paraplanners. And I thought that was a real shame. So we're not doing a particularly good job of sort of articulating the benefits of this profession, because I think most people still think you need sort of to be fairly highly robust and have fairly, stern sales skills to be able to succeed. But as we all know now, there are different ways of approaching advice, and there are different ways of engaging with clients and ensuring they don't make those decisions that their future selves come to regret.
Okay, that's really interesting. Louis, what about the investor side? I know you've done some work there.
Yeah, so thinking about the male-female dynamic from the investor's perspective, actually, we see similar effects. So actually, there tends to be this bias towards women. So when you look at a couple in a relationship and they're having they're completing their risk profiling questionnaire, for example, the advisor goes through that data and then creates a solution based on a joint risk profile. And often what we've seen in our research is actually because, as Mark said, they tend to be male advisors, they actually tend to then gravitate and more towards the male, not only in the conversation and the discussions around their finances, but also in that overall risk profile. So you tend to find that the risk profile sits closer to the male, if it's a couple, the male's risk profile than it does to the female, and obviously that can then have a knock-on effect. And so I wonder if having more females in this profession will help in having those conversations and opening up the conversations to both partners. And obviously the ongoing effect that can have.
Yeah, and then finally, I know we mention it all the time, but what is the role of AI here? I mean, can it help with emotional decision making and things like that, or is it a hindrance, or does it, as ever, depend on how we use it? I mean, Louis, let's go to you first on that.
Yeah, so I think we've both expressed the emotional benefits of working with an advisor, with a human being, and I think at the moment AI will help advisors and is helping advisors to create summary notes, help reduce the time they're spending on suitability letters and with the admin side of things, so that they can actually spend more time with the client and have those interactions with the client. I think the emotional side of assessing a client's emotions through AI, we're still at an early stage. I mean, we've been talking about eye tracking, and there's lots of research there looking at eye tracking, looking at facial expressions. So by eye tracking, I mean eye movement behavior and pupil dilation and things like that, voice and tone of voice. But I think that when we're looking at understanding an individual's emotions, that it's not just about detecting emotions. It's not just about seeing that someone is smiling, so someone is happy or someone is sad. There's a lot more that the advisor, in terms of their emotional intelligence, there's a lot more that they need to be able to have a conversation about how are you feeling? How can my emotions as the advisor influence your emotions and your behaviors and your decisions? So I think we're still at an early stage with the emotional AI side of things replacing an advisor, or I think it can be useful in terms of maybe we're having this conversation, so using AI could pick up some of my expressions, some of the words that I use, and can summarize how I feel about a certain topic, and an advisor can maybe use that. But it's going to miss out on lots of different things. It's going to miss out on my gestures, my facial expressions, all of those. And actually, there's other biases that the technology may be using to assume that I feel a certain way. So I think there's still a huge role for the advisor, for the human, when it comes to understanding the client in terms of their emotions and helping the client.
Okay, Mark, last word to you on that.
I agree with Louis, really. I think AI could arguably be one of the biggest useful tools for advisors in terms of, the capacity to run the business and deal with administration. But also I think it's arguably one of the biggest threats. And certainly the work we do is really about the importance of staying human and really understanding what is important to clients, those very human emotions, that narrative of your life and the emotions associated with it. That's far more arguably important than the facts and the figures. AI will get better and better at recognizing emotion. There's no doubt about it. But our advice to advisors is get very, very good at being human. and understand that, that people make decisions. They make what may seem to be irrational decisions, not because they're stupid, because they're wired to make them. And actually, once you explain to clients and you teach them a little bit about themselves, that yes, it is right that you don't like falling markets in exactly the same way as you run away from a falling market is exactly the same emotion that says, you run away from a bear. I mean, it's exactly that. This is a fear thing. It's completely natural to do so. We are naturally loss averse. We are naturally cautious people. I mean, couple of thousands of years ago, if someone was walking along on a path and they didn't know whether what was in front of them was a stick or a snake, but they decided to pick it up, they're not long for the gene pool, are they? So we are naturally cautious. And so understanding these emotions and basically getting clients to understand, look, the reason you need an advisor is just to explain to you, to have that emotional coach in your corner that says, look, I know you want this to stop. I know you want it all to end, but hang on, because things will get better. I mean, in 2008, any advisor that held their clients' hands and said, look, yeah, markets have fallen. I know this is really, really uncomfortable, but stay invested. That one conversation on that one afternoon had probably done more for that client's wealth, the wealth of future generations, the wealth for all the sort of people that are involved in there, maybe future contributions to charities, than any platform that added a new bell or whistle, or, with respect to, any investment manager that went overweight in one market as opposed to another. It's keeping that client invested. That is a very emotional thing to do. That's a very emotional conversation to have, and these conversations will become more and more important in the future, I think.
Okay, great. So get good at being human. That seems like good advice to take away. We will wrap up there. Thanks so much, Louis and Mark, for all your thoughts today. Some really interesting stuff there. And thank you to everyone for joining us. Please do keep an eye out for the next episode.